Hi, and welcome to Hedge Fund Manager. I'm Karl-Mikael and we're doing a deep dive into FxV today, and we're moving into the fundamental section, the actual fundamental value section, where we try to find out how much should and probably will FxV be worth within a couple of years' time, which I would consider our investment horizon. But right before moving into the real fundamentals, one thing to consider here is investors' willingness to simply buy what works rather than what is cheap. And what's been working in 2025, for example, are things like gold and silver companies. So that's metals, but it's precious metals, and it's not really the industrial metals that Kazakhstan is exporting. Also, beer and tobacco and construction and maintenance are within the absolute top winners for this year. We can see, for example, here I have a watch list called wonderful companies that I just hope for them to get cheap enough to buy. But usually they are considered such high quality companies and are always in favor by investors. But we can see here how, despite being pretty already loved by the market in 2024. In 2025, we've seen Lundin Gold double, EMX Royalty up by 70%, Canagold by 50%, and all of these other wonderful companies have kept going up in 2025. Silver miners have been doing even better. You see like 10-15 companies here doing between 50 and 135% in 2025, and gold just about as strong as silver. So FxV, with a PE ratio of just 6.9, it's deep value. That's absolutely no hesitation. But is it possibly too deep? Is it so deep value that the market is not willing to take the chance on this not being a value trap or a geopolitical trap or some other problem or unknown risks? So the market is prone to buy what's working, and if FxV is not working, what are our hopes as investors for the market ever discovering, or rather rediscovering FxV again? And how important is it that the market rediscovers FxV, or can we as investors extract some value even if the market keeps treating this like a problem child and never raising, for example, the earnings multiple for FxV? So to start with, even if the price earnings multiples stay at just 7 times earnings for next 12 months, what we as investors will get nevertheless is, of course, the underlying EPS growth rate. So if that stays at just 15% per year, which would be very much a low point for FxV, and it's where their guidance is for this year, excluding the Hepsiburada acquisition. That means that you actually, as an investor, will get the entire Hepsiburada acquisition plus the potential growth that enables in the future. You get that on top of the current earnings guidance of 15% per year. And if they also resume dividends, which I very much expect, it might be that they gradually increase them, so from 0 to maybe 5% earnings yield, and then back to their ordinary 8% earnings yield at the current price and valuation. That would mean a 23% CAGR, even at flat earnings multiples. So what we could look forward to here is, even if the market never really values Kazakh's super app company and coming also Turkish super app company, we would still get a 23% returning stock, and And given that that would also be at just a 7 times multiple, we would always have this really strong buffer against the downside, and also always the optionality or the potential re-rating to a more normal, let's say, at least 10 times multiple. But at a 10 times multiple, you would then get a 50% extra return multiple on top of those 23% per year. So then it depends on for how many years we will have to wait for that 50% revaluation. So let's look at the fundamentals. These are the year-on-year growth numbers for sales in local currency terms, and the acquisition is reflected here in the Q1 numbers. But as we can see, the sales growth rate has been around 40% per year for a very long time. That means that this company has a formula for growing. This absolute latest number of 47% growth rate, that is actually it's the real growth rate, because it includes the acquisition, and the acquisition has happened and they have the acquisition. So even if this is not organic, this is the growth that we as investors will see on the current number of shares and financing situation. The organic growth rate, however, is probably more likely to be somewhere between, let's say, 25 and 30% once they get back on track after digesting these acquisitions. It's always like a two sides to this coin. When you do big acquisitions, you increase the risk, you increase the worries from investors that the digestion of the acquisition will go okay. And typically also the organic growth rate falters a little bit after a big acquisition. But it also includes the potential of selling more products to all the new eyeballs or potential clients that you have acquired. And should remember also that Turkey has more than 4 times the population than Kazakhstan. So this has really opened up a whole new potential growth arena for Kaspi. Backward-looking multiples, well, we can see they used to be at around 10 to 12, and they're currently at just around 8. The numbers differ a little bit from the tables and the charts because they don't measure the exact same time periods. And in terms of forward-looking multiples, they're currently at 7.0 next 12 months or 6.8, measured just slightly different. And this is also down by almost 40-50%. So there is definitely a potential for a re-rating once things calm down a little bit and investors stop worrying about these large acquisitions and also the potential geopolitical worries. In terms of price sales, it's also come down by about 40% to the current 3.2 times sales. Here we can remember my rules of thumb regarding valuation multiples, that I want to pay less than 10 times earnings soon. Well, we're already paying a lot below 10 times. And the warranted price sales ratio is a combination of growth rate and profit margins. And at a net income margin of 40%, that warrants at least a 4 times sales multiple. And now with S&P multiples being 3 times their historical average, then a 4 times sales ratio for Kaspi should be considered really, really cheap. And it's, as I said, currently at just 3 point sales. So the problem here is falling confidence, and the question is when and how can we increase that confidence? And let's take a look at that in the summary section.